Good morning.
Good morning, Safe. How are you?
Good. How are you? Thank you for taking the time to join here. Man, you look
Thanks for having
excellent. What
thanks for having
hotel
me
room
on.
are you in?
I know I look great for this early in the morning, right?
Awesome. Well, thanks for taking the time. I appreciate it. I know we put in some work on some of these real estate predictions. We're a little late. We're in February now, so this is our quarterly series. We're our special guest this time is from Berkadia. Luke Safranek. Aside from being a really good friend of mine, he's a really good lender as well. We just closed a deal over in Warren, 45 units, Park East Apartments, and Luke is also doing another deal for us that should be closing in March now?
Yeah, a couple of weeks.
Awesome. So today we're gonna put some brains together, review our 2022 predictions, and yeah, ready to get started?
Let's do it.
Awesome. Cool. So Divergent Capital, for those that do not know and are unfamiliar with, we are on a constant pursuit of building a diversified portfolio of real estate holdings that provide a steady return regardless of what market condition we may be in. And then B, just as important, is the preservation of our partners' capital while maximizing all of our returns. So what that essentially means is we're buying really well, we're handpicking our properties, we're putting great debt on it, and then from there, we're looking to provide, or we're trying to provide, can't talk today, it's a little too early. Essentially trying to provide as much value to the property to refinance it out, bring all of our capital out, and keep riding the wave. And then Luke, I don't know if you want to do this. You probably know yourself a little better than I do. I'll let you kind of take it.
Yeah, my name's Luke Safranek. I work with Berkadia Commercial Mortgage. Berkadia is the largest Fannie, Freddie, and HUD lender in the country. And then on top of Fannie, Freddie, and HUD, we've got a variety of other lending sources, lending options. Berkadia does about 25 to 35 billion a year in debt all across the country. We've got offices in almost every major city. So we have debt needs for almost any type of loan that you can imagine. Anything with cash flow, even sometimes land loans, we can get done. Our specialty is really long-term, non-recourse debt. That's what we're best at, and that's the kind of stuff that's hardest to find. I've been a mortgage banker for about 9 years now, 2 different shops, but I've been with Berkadia for 7. And it's been a fun ride, and I've been able to meet a bunch of fun people, finance deals all across the country, pretty much every property type I've had a chance to look at. And I love to work on the hard deals, work on the stuff that needs a little extra thought, and the stuff that needs a unique lender. So I like to kind of say I'm there for almost any commercial real estate loan. And I'll tell you pretty quickly if it makes sense to do it with a lender that I can provide or someone else, or what the best source is.
A quick no is better than a maybe, huh? Especially in this business. Cool. Well, thanks for joining us again. I appreciate it. So this presentation is really broken down into 4 key topics. So we're going to talk about the U.S. economy, kind of the employment status, the wages, the inflation, the overall growth of the economy from pre-pandemic levels all the way to kind of in the pandemic. And then now that you can kind of consider us out of the pandemic, and then into capital markets, we're going to talk about cap rates, price growth, market share. And then the third thing, which I love most, is multifamily, the demand of it, the rent rise, the construction costs, and then kind of what lenders love, right? I think, Luke, you'd agree that workforce housing is ultra competitive, and lenders really love the asset. So we'll kind of dig into that. And then last but not least, we'll talk about some financing stuff, recourse bank loan, Fannie, Freddie, non-recourse bridge, kind of what Luke was talking about, as well as some CMBS products. So some things that we're hearing in the market, I think, Luke, I think you'd agree, some positives, some negatives. There's definitely skeptics out there that, from 2018 have been saying, hey, we're going to have a crash, we're going to have a crash. But the market essentially continues to rise. It's, we have compressing cap rates. We have people are coming in and saying, hey, there's a huge housing demand, which is essentially coming from people that can't purchase houses. Like, there's just not enough inventory on there. And I think we've been hearing that for the past year. And even in our last presentation, there was just a huge housing shortage, which is causing a lot of people to go ahead and rent. And a lot of these realtors on the retail side are saying, hey, let's sell your house. And I don't think people are realizing, okay, like, great, I can sell my house. And then they get into it. They don't know how quickly they can sell it, and they can't find anything else to go into. So they're renting. These qualified house buyers are renting now, which is creating a higher housing demand. Other than that, like, besides, in the last few weeks, rates have been historically at a low, and there's a lot of outside money coming in. I don't know if you have anything else to say to that, Luke.
Yeah, no, you're absolutely right. The housing market is extremely competitive right now, which is just forcing a lot of people that would normally want to buy maybe to rent for a little bit, or some people who, like you said, have houses and want to sell them. They know they can make some money. Say, hey, we'll just sell, and then we'll rent for now and maybe buy when the market cools down a little bit. But yeah, this with the super competitive housing market, apartments are becoming even more and more popular. And then also with the rise of COVID, everyone realized that they can work from pretty much anywhere, and a lot of people are working from home, and that makes apartments even more interesting because people are traveling a lot more, and people are saying, hey, I can go down south in the winter and go back up north in the summer, and I can pretty much work from wherever I want, and I can go to the ski slopes and go, live in Colorado for a couple months and ski. So people are saying, hey, I can move around as much as I want, and that makes apartments and Airbnb properties and stuff like that even more popular.
By the way, I didn't realize I wasn't sharing my screen. Am I sharing my screen?
Now you are.
Oh, you didn't tell me this entire time?
Dude, we were just looking at you, your handsome face,
Oh, awesome. Okay, well, I was trying to show my PowerPoint that we worked so hard with. So I think another big thing that we're seeing is the placement of capital, right? It's an ultra competitive market. I think there's a lot of outside capital coming, a lot of foreign capital coming as well, which is, I mean, with the addition of compressing cap rates, I think that it's a big add-on to it, right? There's a lot of capital. We'll kind of talk about dry powder later in the deck, but I think that's also another reason why people are just trying to hedge against inflation. And a lot of people know that real estate is the place to park your capital.
Yeah, absolutely. People see it as a safer spot to park their capital, and like you said, yeah, hedge against inflation, because expenses more or less stay the same overall. They're not going to fluctuate like crazy, but on the income side, you got the ability to raise rents with inflation. So real estate definitely makes sense as a good hedge.
Absolutely. And there's definitely some negatives, right? Especially in the last 2 weeks. I think, Luke, you guys saw some rate hikes, right? And I'm sure you guys had folks that had their files with you guys, and they experienced their interest rate going up. How is that kind of looking for you guys?
Yeah, since the new year, rates have really started to rise, and everyone kind of knew eventually treasuries were going to go up. The Fed kind of signaled that for a while. Eventually, rates are going to have to go up. So that was kind of expected. What was unexpected is the other kind of volatility in the market, which causes people's spreads to rise. So not only are treasuries going up, but also the spread or the risk quotient that lenders want is also rising at the same time. So you've kind of got like a double whammy. So even though treasuries have only gone up 40, 50 basis points since the new year, lenders have also raised their spreads, depending on who you talk to, 30, 40 basis points. So you're looking at almost 100 basis point rise in rate. since the new year. So it is a little concerning to see rates going up that fast, but I think it's important to realize that historically rates are still incredibly low. So, people, if you set up your model expecting a certain rate, and you're not going to get it all of a sudden, that's scary. But overall rates are still historically very, very low, and people got to remember that as well, that 4% rates are nothing crazy. If it goes up another 100 basis points this year, then deals are really going to start to not work, and that will be a cause of concern.
Yeah, absolutely. I want to talk to you about kind of the 10-year treasury, the Fed fund, kind of on the next slide here. And I think it'd be a good time to shift there. So a couple things that we're seeing, right? Employment is starting to pick up post-pandemic. 10 million, there's still 10 million jobs that are currently open, and they're forecasting a 2% rise here in employment. And kind of just going back to multiple rate hikes, right? I think we already had one or two. Luke, you'd probably be a better candidate to inform us on. I think there was 2 rate hikes that already took place. They're saying that there's another like 83% chance of rates being above another 50 basis points by the middle of November. What do you kind of see in terms of rates here? A bit of a deep dive here.
Yeah, it's the Fed is trying to signal that there's, as long as inflation stays at the rates that it's at now, and it seems to be going up pretty steadily, they're gonna absolutely raise rates. So I don't know exactly how many rate raises there's going to be, and we don't know exactly how much they're going to raise them, but the market is definitely pricing in an expectation that they raised them once, and their expectation is that there's going to be 2 to 3 more raises in rates this year. So we'll see where it actually ends up. But I've seen a lot of people predicting the 10-year treasury to end up around 2%, which, last year it was right around 1%, dipped below 1%. Then it's still got some room to run, I think. But 2%, I think, is the high end of where the 10-year treasury should end up.
Okay, sweet. So this kind of our capital markets slide kind of talks about dry powder, and this is kind of surprising actually, but not surprising by a lot, right? $200 billion in dry powder, kind of crazy. But I feel like there is a lot of sideline money going on, and cap rates. I know last year was a crazy year in real estate. Cap rates really compressed. And even the year before, right? People were saying, holy crap, like you're buying, a 6.5 cap, 7 cap. It's kind of crazy. Now we're seeing those same properties trade at, a 5.5 cap. And kind of research is saying that, hey, it's forecasted to kind of stay the same. What are you seeing as you're underwriting deals?
Yeah, I'm sorry, I misspoke on the last slide. I meant 3%, not 2%. We're already at 2% with the treasuries. But up to 3% is where, people are saying maybe things could go, which would be quite an increase over the last couple of years, but still historically very, very low. So yeah, in terms of cash out there, there's a ton of capital in the market. There's a lot of foreign capital coming in. There's tons of money flowing into real estate funds right now, and that's what we've seen as the biggest driver of cap rates going down and prices getting more competitive. Is there's tons of money flowing into real estate funds, flowing out of the stock market since the beginning of the year. People are saying, the stock market looks a little risky. It looks a little overheated. Let's look for some alternative investments. Let's look for some hedge against inflation. And yeah, multifamily is a great spot for that. So you're definitely going to see money keep flowing into real estate. Maybe not quite as much as the last couple of years because it's just been so extreme. So yeah, it might stay more or less flat. But I think I don't know if we're going to see more cap rate compression, but they're already so low. As long as it stays where it is, it's already a super, super hot market. And then the increase in rates will somewhat temper, I think, real estate investment um, as cap rates are just it's hard for cap rates to go down when interest rates are going up. Cost of capital becomes more expensive. It's going to make cap rates go up and prices to kind of stabilize or maybe even go down a little bit.
Absolutely. So one remark that, or one thing that I want to kind of bounce off you, I'm sure you get this question a lot, right? Everyone kind of knows it's super important in commercial real estate to know where the 10-year treasury goes. And I think it's really, really hard to predict. And that's a question that I never answer, right? When someone asks me that question, I'm just like, I don't know. Right?
Yeah. You
Try to
don't have a
defer
crystal
that.
ball. There's no one knows. If trust me, if we knew, we wouldn't be here.
Yeah, absolutely. So I'm sure you're probably getting the question, right? Fed fund rates are with the Fed fund rate, right? It kind of goes hand in hand with your floating rate, and I'm sure you're getting a lot of questions from groups that are saying, "Hey, do we fix? Do we float? Are interest rates gonna, run on me?" What's kind of your advice that you're giving a lot of folks now that we don't know what's going to happen to the market, right? There's a couple rate hikes that are anticipated. What are you kind of seeing here? Other groups taking, and what are you advising?
Yeah, my advice is you can't really predict the market, and you shouldn't try. Rates are at historical lows. If you've got a deal that you think that is pretty close to maximizing its upside, you should absolutely lock the rate. I think today, people always, for the last couple of years, rates have just gone down so much. Everyone's like, oh, well, if I lock now, and what if rates go down? And I'm like, yeah, you always run the rates of risk going up or down, rates going up or down. But if you've got a deal that's stabilized and ready to be locked long term, I think now is the time to do it. It seems like the trajectory is for rates to keep going up and up. So, I mean, like I said, I don't want to predict anything. I don't have a crystal ball, but I do think that if your deal makes sense, you should lock it long term and put it to bed. Floating rate deals still do have a place for properties that are, might still have some upside to be unlocked, and you don't necessarily want to lock in a long-term rate with a big prepayment penalty right now. So there still is a place for the floating rate debt for sure, if there's enough upside in the property. But if you're close to stabilized, my advice would be put it to bed so you don't have to worry about it. It's not worth the stress and the risk of rates going up at this point in the market.
Awesome. Kind of my favorite section here, right? The stuff that we're involved in most is multifamily and why we love it so much, right? The rental growth and demand. So 2021 had seen approximately 4.5% rental growth. Pretty crazy. And, I would say year over year, we're seeing a rental growth of like 2%. So 4% was like almost double, right? And we're expecting that in 2022 here, just roughly 2%. And I think kind of just going back to what you were saying, Luke, earlier in the presentation here, the pandemic is really increasing the housing demand with people selling, people knowing that, hey, I could be in two places. I can be in Michigan while it's summer, or I could be in Florida while it's winter. Has really helped us, right? And I think they're still saying rent is forecasted to go up in the next four quarters by a substantial amount. I think it's, they're saying it's 6. I think this is like conservatively 6%. They're saying, in certain areas across the nation, there's going to be rent growth that's going to be seen at 8.5%. So the really cool thing is institutional capital is still chasing that A and B class deal. And I don't know, what are you kind of seeing from institutions here?
Yeah, so the institutions are still out there. Yeah, exactly. Like you said, they're trying to chase class A and B stuff, and their needs for returns they go down and down. I mean, it's amazing the cap rates that they're willing to pay for good quality stuff. But the reason that they're willing to pay those low cap rates, even for stabilized deals, is like you just talked about, it's the rent growth. So If rent growth is really going to go up by 3, 4, 5, 6% over the next couple of years, I guess a 4 cap makes sense, right? So if you're paying a 4 cap or even a sub 4 cap for a stabilized property, right now the returns aren't so great, and it might seem crazy, but for them, they've got money that they need to put out. It's just sitting around. They're paying interest on it, so they have to put it out. And if rents keep going up like they have the last couple of years, then eventually they're going to be okay. And so the institutions are usually long-term holders. They're not scared to take a property and hold it for 5, 10 years. So they think they'll be able to take advantage of that rent growth. And the demand for housing is always going to be there, right? So you can make the argument that people are going to use hotels less because of the pandemic. People are going to use office space less because of the pandemic. People are going to need less retail because of Amazon, but some people always need a place to live. So that's one product that's always pretty safe.
And I think it's derived from, construction costs, right? Right here, I mean, $13,000 just lumber is adding an average of $120 per month on new construction units. So, which is crazy, right? Like, yeah.
And that's part of the reason that there's such a shortage in affordable housing, right? The biggest issue in America right now is, and one of the biggest issues in terms of multifamily is there just isn't enough affordable housing, and costs for living in an apartment are going up and up. And part of that problem is you can't make the numbers work for affordable housing because the construction costs are so high. I mean, construction costs have skyrocketed, and timing because of supply chain issues has gone up. So now for people to make their money back on new construction deals, they basically need top of the market rents. And it's hard to price affordably when it's so expensive to build.
Absolutely. So kind of going into workforce housing, right? Just touching on it a bit. They're still saying that it's expected to continue at, the lowest vacancy rate in multifamily. And I know this is why we love workforce housing. And I think the majority of our portfolio really fits into this bucket, just because debt is super, super important to us. And it's a favorite class by Fannie and Freddie. Can you kind of get into why Fannie and Freddie kind of love this product so much?
Yeah, absolutely. So Fannie and Freddie are quasi, government sponsored entities, and the government really wants to, if the government's going to be subsidizing housing, they're going to be subsidizing housing, for the affordable stuff, right? They're not going to be subsidizing housing for rich people, for super fancy high-end apartments. Those people don't need subsidizing. So they really want there to be more affordable housing, and their mandate is to help provide more affordable housing. So they're going to provide better terms if they consider it affordable housing. They're going to be a lot more aggressive on the affordable housing front, and every year they seem to allocate more and more money for the affordable housing buckets, which include small balance loans, and it also includes mobile home parks, stuff like that. So they really want borrowers to be incentivized to keep their properties affordable, keep their rents lower, and to do that, they're going to lend more aggressively on those product types because there just isn't enough of that housing. So to create more of it, the only way to really do that from their perspective is to just make their loans more aggressive for that type of product.
Absolutely. Cool. So let's go into some of the financing stuff. I know some of our listeners are curious to kind of see the appetite that these four products have to offer. So I'll kind of let you get into it. And yeah.
Yeah. And the biggest thing that differentiates these loans here is really recourse, non-recourse. Banks, there are so many different small banks, big banks out there. You can find almost any bank to do your loan, because banks really care about recourse, and they care about the sponsorship a lot more than just the property. So they care about the property as well, but there's always a bank out there who will say, hey, yeah, if I've got a sponsor that's worth, X amount of dollars, I'll basically do any loan for them. If they're going to deposit some money in my bank, I'll do that loan for them. So when you've got a personal guarantee from a really strong sponsor, it makes it a lot easier for them to get flexible and basically do any type of loans. The reason I put desired loan size there, any, is because there's small banks that'll do small loans, there's big banks that'll do big loans, and they're usually shorter term loans with balloon payments that come a little bit earlier, but their appetite is pretty much, almost any loan I can find some bank to do it, as long as the sponsorship is strong. And that's really the key thing for them, is they're going to want to see tax returns, personal financial statements. They're going to ask for deposits. So it's more for them. It's more of a just kind of whole relationship rather than just looking at the property. And then the other lenders that we have on here are non-recourse, which means they are not going to get personal recourse. They're just going to get the property as their collateral. So they're going to pay a lot more attention to how the property has performed historically, how it's going to perform, projections on how it's going to perform in the future, how the property is performing right now. They're not going to take, we can get to bridge loans in a second, but at least for Fannie and Freddie, they're really going to lend on, they're going to look at the trailing 12 months, the trailing 3 months, the trailing 1 month, the current rent roll. They're going to really focus on delinquencies. But they're really going to focus on the numbers in place right now. And they're not going to look at projections. And a lot of people say, oh, well, I project rent growth to go up this much, or I think I can raise rents at this property this much. They don't care. They're lending a non-recourse loan, which means if you flip them the keys and give them the property back, they only get the property back and nothing else. So they want to make sure that the numbers are going to work in place day one. And so they can get fairly aggressive on those numbers. But if they're giving someone a non-recourse loan long term, they're going to be doing it on the in-place numbers right now. So Fannie and Freddie are a little bit more particular. They want to see properties that are over 90% occupied for at least 90 days. They're looking at bigger loan sizes, and they're going to underwrite to a 125 debt service cover on a 30-year amortization on in-place numbers. And everyone always says, oh, well, like last month was great. It doesn't matter. They're going to look at the trailing 3 months, the trailing 12 months to determine where they lend at. So yeah, Fannie and Freddie are great products for long-term fixed rate debt once a property is stabilized. But then that gets us into bridge loans. You can use a bank for bridge loans, especially for the smaller stuff. That's usually the easiest route. Under $5 million, it's really easy to the easiest route is to sign recourse, get a bank loan. Once you get into the bigger loans, not everyone wants to sign recourse on the bigger stuff. So right now there's a bunch of debt funds and bridge lenders out there who are giving kind of short-term non-recourse loans at really high leverage points. So we're talking like 80-85% leverage. They'll give you money to do construction. They'll give you money to turn around a property, and it's all non-recourse. And kind of the reason that they'll get so aggressive with these deals is a lot of these debt funds look at it as, well, if this person doesn't complete their business plan, we'll do it. And it gives them an opportunity to say, hey, if this person completes their business plan and pays us off, that's great. We make money. And if not, we get a property,
Are you
for
still
80 or
seeing
85%.
Are you still seeing non-recourse bridge super aggressive right now? I know earlier last year, like if you had a deal that was like 7.5 million, you'd come back with like 10 bids from different banks, right? When you go shop it out, like this was an ultra aggressive product last year. Are you still kind of seeing the same?
Yeah, absolutely. I just got back from the mortgage bankers conference out in San Diego, and yeah, that's kind of the talk of the town. Every debt fund has a bridge loan. Everyone wants to put bridge money out. Super competitive right now. Rates are very low. I mean, you're looking at the fixed rate for stabilized properties is almost the same as where the bridge lenders are ending up in rates. So you're talking like low 4s, even high 3s for transitional multifamily properties. They really like to see a clear path to how you're going to stabilize the property. So that's the biggest thing. Some people say, oh, I just want to buy a property and raise the rents over the next couple of years. They don't really necessarily believe in that model unless you've got really
sometimes that's the story. Sometimes that's the story though.
Listen, if you've got really good comps for that, Some lenders will be okay with that, but they really do like to see some improvement in the property. They want to see a CapEx budget. They want to see you improving the units. They want to see you, fixing up common areas. They want to see some money going into the property. So
Absolutely.
their preferred loan is, hey, we'll give you the money to put into the property, but we want you to put some money into the property. But yeah, it's a super competitive space. Lots of lenders out there doing that kind of thing. And you can, if you've got a halfway decent deal, you'll have lenders fighting over it.
Do you see groups? I know groups are ultra aggressive, right? Like, especially me leading up the acquisitions, right? I'm in front of all this stuff. I'm submitting LOIs. I'm figuring out, okay, a deal traded, right? 3 months from now. Okay, it traded. Why did we lose the deal, right? What were the lessons learned? Was it, did it trade under? Did it go over? And most of the time, 95% of the time, we just weren't close, right? We're seeing groups become ultra aggressive. Do you see groups leaning more towards the non-recourse product, or are you kind of just seeing a balance of that right now? Because I would have to assume, right, some groups knowingly are signing on debt, or they're taking on properties with lesser cash flow. And I'm sure these people don't want to be on the hook for it. So what are you seeing? Or is that
and
not
you
really it?
Yeah, you're really good at analyzing the in-place numbers. And the reason that you're losing these deals is because people are buying them based on their projections. And bridge lenders will look at those projections. That's the difference between Fannie and Freddie and even a lot of the banks, is that the bridge lenders really will look at your projected values, your projected rents, everything like that. So when you're losing deals, you see someone, you say, oh man, he's paying a 3 cap for that deal. I can't believe he's paying that price. Well, for them, within 2 to 3 years, they're going to be at a 5 or 6 or 7 cap, because they're just basing their purchase price on the upside that they see. And you're 100% right. These people are almost always getting non-recourse loans.
Okay.
There are very few people paying 3% cap rates and then saying, oh yeah, I'm fine with signing recourse. If you've got one individual guy who's doing it, yeah, but usually it's funds buying these. It's a group of people, and it's always the biggest fish that is really the most liable. And so that person doesn't want to sign recourse for the entire thing. Recourse is almost always joint and several, which means everyone's signing recourse for the whole loan. So yeah, non-recourse bridge loans are super popular right now. No one wants to borrow 85% leverage after buying a property at a 3 cap and then sign recourse. They're all looking for non-recourse debt, and they're finding it right now, which is really driving cap rates down.
Yep. And kind of when you go recourse to non-recourse, what can you see in terms of like the rate difference, really?
Yeah.
And I know it kind of depends on the loan size, but what are you kind of seeing? Like,
yeah, it depends on the loan size and depends on the type of deal. And we're just talking straight multifamily. There isn't that much different in rate, to be honest. But the difference is
go non-recourse at that time, right?
Right,
So
exactly. Why not go down recourse?
Exactly. Yeah.
The difference is in the terms, right? So like a bank will give you a 5-year deal with maybe a little prepayment flexibility. A bridge loan might just be a 2 to 3 year deal, and the rate is floating, so there's a little more interest rate risk there, and you've got to refinance in 2 to 3 years usually. So there's the refinance risk. And then the bridge loans might just have a little more structure. But anyway, it's just the differences in the term. The rates these days are amazingly almost across the board the same. But like for Fannie or Freddie, you're locking that rate in for 10 or 15 or 20 years. So it's a good rate, but you're locking it in. And then the bridge loan will have the same rate, but this is a 3-year floater. So it's just a lot different.
What are you kind of
the risk there?
What are you kind of seeing recovering wise in the retail space, the office, the hospitality, and kind of like senior properties in terms of financing?
Yeah, it's been a slow recovery for sure. Office hasn't performed as bad as people thought that it might, but lenders are still super cautious because a lot of office space has longer term leases with big corporate tenants. So it's not like those corporate tenants are saying, oh, we're just not going to pay rent. A lot of people that are working from home are still saying, well, are we going to have people come back to the office? Are we going to need our office space eventually? So businesses are kind of trying to find the exact right combination of work from home and work back in the office before they give up their office space. So what we're seeing is a lot of office users or office tenants saying, well, can we get some time? Can we get a short-term lease? Can we get month to month? Will we figure out how much space we're going to need? So lenders are cautious, very, very cautious on that space. Unless you've got some good tenants with long-term leases, they're probably going to stay away from it. And that, but there are loans if the leases are long, because chances are people aren't going to break their lease even if they are working from home.
What are you kind of
But yeah,
seeing in retail?
in retail,
Yeah.
yeah, retail's actually done a lot better than expected. I'd say retail during the pandemic, I mean, obviously at first when everyone was at home and no one was going out, people were worried about retail, but it's really come back in a big way. I mean, people are out shopping, people are spending a lot of money. People got money from the government. Everyone's doing pretty well. There's a lot of money out there, so people are buying stuff. But I would say before the pandemic, people were more worried about retail than they are now. Before the pandemic, everyone was worried, oh, Amazon's taken over, big box retail is dead, malls are dead, retail's in a really tough spot. No one really liked retail. Now, since the pandemic, people are more down on senior housing, hospitality, office than they are on retail. So grocery anchored retail can always get done. Lenders love that. Some of the strip center retail, as long as it's well occupied, that'll get done. Big box retail is still tough. So it really just depends on the market and on the tenants and kind of the size of the property. But if you've got big box retail, that definitely is a little tougher. But the smaller stuff, the smaller kind of services that are always going to be needed, that's never going to go away, right? Like food, people are always going to need food services, haircuts, stuff like that, all the little services. So if you got a bunch of service tenants in your center, I don't think you always be able to find loans for those. It's the big box stuff that's a little scarier.
There's something with Louis Vuitton. I just seen something one of my buddies showed me. He was like, they keep like selling out of everything. There's like a major shortage, and then Louis Vuitton's like, hey, the prices are going to be going up. And I just feel like every time I go to the mall or something, Louis Vuitton has a line literally across the place. I'm like, wow.
Yeah, it really is amazing how well they've done through the pandemic and what a high demand there is for their product. And the supply chain issues are huge as well, because they just don't have as much stuff. And so when they do, everyone wants to be the first one in there to get the new thing or to get the thing that's been out of stock. So the supply chain issues, I think, really feed into that as well. They just don't have as much product to put out either. So there's enough demand to keep raising prices.
Absolutely. So let's wrap this thing up. Some of the things that we've talked about, right? Supply chain issues in the U.S. economy will continue to be resolved given some price relief and driving GDP growth. I feel like multifamily, I think we agreed that rental rates will continue to grow while, cap rates are going to remain unchanged. They're still going to be aggressive. I think people are still going to continue to buy 3 or 4 caps with a little ability to grow. And, kind of going back to what you were saying, in 2-3 years, seeing the value, right? I'm still trying to adjust in my head. Like, I'm trying to project in my head, like, hey, 2-3 years down the line, we're going to get to where we need to be. I can see myself paying this X price. I'm still trying to drill into my head, right? Because it's been, a 6 cap in my mind the entire time. And I'm like, man, and there's so many deals like in the past, right? And I'm looking at it like, wow, I should have bought that deal. I really didn't buy that deal. And now I would have bought that deal, eyes closed, blindfold on, right? Like,
Right. Cap rates just keep going down. You can't predict it. Rates kept going down, and interest and cap rates kept going down the last couple of years. So almost anything you bought, you could just buy it and hold it, and you would have made money because of just of cap rate compression. So yeah, every deal looks like a good deal now. But we'll see if that trend continues with rising interest rates. I don't know how much more cap rate compression there's going to be. I think it's at least going to stabilize because of interest rates.
Absolutely. And I think, with the rate hikes, I think inflation is going to continue to drive more dollars into CRE, period. I think there's, just looking at our investor base, right? There's people out of state. There's people that are inquiring about, hey, like I want to bring money from Argentina or Israel, right? We have a lot of money that's coming from there. So I think we're going to continue to go ahead and see that. And I think in the financing, right? Kind of what you said, if you have good real estate, it's going to continue to get financed at good terms. And multifamily just being the asset that it is, I think at least whenever I get quotes from you, right, they're just phenomenal and they're consistent, right? Like, yeah, I'm seeing a little bit of a change, but overall, right, like, yeah, rates went up a little bit, but lenders are coming back and saying, hey, we'll give you a year of IO or 2 years of IO or whatever that is, right? So
Right.
you're seeing that offset happen.
Right. So yeah, I mean, rates, were in the low to mid threes pretty much all year last year, and now they're probably in the high threes to low fours. But at the end of the day, that's not it's not a huge increase. The rates, like I said, are still historically super low, and lenders are still getting aggressive. Yeah, with interest only, longer amortizations. Yeah, there's plenty of rent growth out there. Lenders are super aggressive, and rates are still historically very low.
Awesome. These are kind of, this is why we love real estate, right? The stability, the appreciation, the leverage that you get from the debt, the strong returns, the tax benefits. We use cost segregation. These are just a few reasons why we continue to buy real estate, whether that's retail, multifamily, or whatever it is, right? We really love this asset class, and I truly believe, right, it's one of the best investment vehicles out there.
Yeah, it's one of the best. It's hard to compete with because of all the tax advantages, and people are always going to need a place to live, right? So multifamily, it's never going to go away.
Absolutely. So how do the listeners get in touch with you?
You can call me, email me, text me. I prefer email. I like to have some numbers in front of me when I'm talking to someone. But you can call me and discuss a deal, discuss terms anytime. But it's nice if you can shoot me an email first, just so I can have some numbers and have some idea of what we're talking about right in front of me. But yeah, feel free to email, call, or text anytime.
Awesome. Well, thank you for your time. I appreciate it. I hope our listeners found this helpful. If you guys have any questions, feel free to reach out to any one of us.
All right. Thanks, Dave. Thanks for having me on.
Thank you. We'll talk to you soon.
All right. Bye.
See you. Bye.